And good morning and welcome to Ask Me Anything, US and international tax incentives for film and television. And before we get going, I'd like to introduce Andy Seltzer, who is the Senior Director of Marketing at Wrapbook. With over 15 years experience in production, payroll, and accounting, he has worked with clients across independent films, studios, streamers, and commercials. Since 2022, he has been proudly working with Wrapbook to bring a modern, friction-free payroll solution to international filmmakers. Over to you, Andy.
Thanks, Robin. Yeah, excited to be here with Wrapbook, where we're building the next standard for production payroll and accounting. You know, the entertainment industry is once again in a state of transition. You've got studio restructurings, the streaming wars, rising costs of film financing. All of this puts added pressure on producers, production accountants, UPMs. The whole production office is being asked to do more with less. You're facing greater scrutiny and tighter budgets on your projects than ever before. Meanwhile, you're being held back by legacy processes for crew onboarding, payroll, production accounting. Wrapbook launched in 2018 as a force multiplier for the production office, allowing you to significantly increase the efficiency, accuracy, and output of your team without increasing costs. We do all that with next-gen technology, backed by a concierge service model with the best paymasters in the industry, union and non-union, and we are engineered for rapid innovation. We've got a quick video here to show you a bit more of what that looks like. Thank you so much for having Wrapbook as part of this IFTA series. We'd love seeing you all out at AFM, and we'll be at South by Southwest coming up. Come and see us at our happy hour there. Thanks again.
Thank you, Andy, and for Wrapbook for sponsoring today's webinar and your company's continued support of the American film market. Before I introduce our speakers today, we have received an overwhelming number of questions ahead of today's session, which our speakers are using to inform their discussion today. We will also reserve some time for live questions at the end. If you have any questions, you can submit it in writing by entering it in the Q&A box at the bottom of your screen. Our first speaker today is Jeaneane Davey, who is an experienced production tax and incentives professional with over 12 years of hands-on experience working with production incentives. She began her career in general tax compliance and consulting at PricewaterhouseCoopers in 2009, where many of her clients were in entertainment and media. After accepting a position in the corporate tax department of Fox Entertainment Group in 2013, she soon joined Fox's production tax planning incentives team and advised on all production-related tax and incentive matters for Fox's feature film, television, and sports divisions until leaving for Netflix in 2016. Jeaneane then left Netflix in 2025 after having led different teams which collectively and at different points in time supported all of Netflix content teams, as well as Netflix's studio-wide initiatives from an incentives and tax perspective. She holds a Master of Accounting from the University of North Carolina at Chapel Hill and is a licensed CPA in the state of California. Our second speaker today is Ryan Broussard, VP of Sales and Production Incentives at Wrapbook. He has worked with productions of all sizes, from the large studio features to the smallest independent projects, helping them to optimize their production incentive strategies and make the most of their budgets. As an industry expert, Ryan's career in production payroll began 16 years ago. During that time, he's worked at payroll companies like Entertainment Partners as a senior account specialist, at CAPS as a tax incentive manager, and with Media Services as vice president of sales and production incentives. He has worked on production incentives from nearly every possible angle, developing innovative reporting measures to facilitating faster audits, advertising countless productions on state tax incentives, and helping states and local jurisdictions to design their program. It's now my pleasure to introduce Ryan Broussard to kick it off.
Thanks, Robin. Thank you, and hello, everybody. Welcome to this Ask Me Anything that I am always privileged to be a part of. So happy and honored to be doing this with Jeaneane, whose resume speaks for herself, and she's amazing. So I'm so very happy to be doing this with her. Like Robin said, please submit your questions as we're going, but we did get a slew of questions prior to us beginning, and all great questions. I will be honest, some of them, there were some repeats, so those are the ones that we're going to try to focus on. And also be aware that as you're typing, as we're going today, we might get to your question, because a lot of these questions are the same questions that other people and your colleagues might have. So no stupid questions, but a lot of times people do ask the same things because maybe it's foreign to them, or they've never had that experience with a particular incentive. So with that said, I do kind of want to just kick it off with what is a production incentive? Because based off of the questions in the audience that we're talking to today with all of you, I think it certainly runs the landscape of people that may be trying to use an incentive for the very first time, and other experienced people that they've done it many times. They want to know what's changed with a certain jurisdiction, or what's coming, or hey, I've done it 5 times here but never here. So just know that we're going to hopefully cover everyone here, because once again it kind of runs the gamut on what you guys are asking today. We're going to try to cover it all, but we do only have 90 minutes, so we're going to try not to go into any big rabbit holes of like one state or one thing, particularly like in extreme detail. Me and Jeaneane talked before this, and we could talk about a jurisdiction for an hour each if we wanted to. So it's kind of hard to do that, but we are going to hopefully answer the majority of these. So with that said, what is a production incentive? So if you don't know, I guess almost 20 years ago, Jeaneane, keep me honest, the US and Canada kind of kicked it off with incentives, and then the US started getting into it with Louisiana, New Mexico, and Georgia kind of being the first 3 to roll it out. They were doing incentives to try to get people to film in their areas. So that's the one big takeaway with that very vague description is, in order to get any of these programs, you have to film in these jurisdictions, what I like to call boots on the ground. So you have to be there, you have to be spending there. Your crews have to be working there and utilizing, for the most part, like 98% of the time, local vendors. So just something to keep in mind when talking about tax incentives in general. There are different types, and not to once again get in a rabbit hole with it, but the basic ones are there's grants and rebates, which I like to describe in a very like kind of average Joe way as just a bucket of cash, right? So it's like they have the money, it's set aside, it's budgeted, it's there. You don't have to do tax returns or any of these types of things for grants and rebates typically. Then there's tax credits, which there's quite a few of those. There's refundable, which means you fully get your dollar for dollar back if you don't have any liability in the state after you do your tax return. So you get that check from the state. But once again, after you do a tax return, or the company's tax return, or the LLC, which we'll get to, Jeaneane is an expert with that type of stuff. But you want to file the tax return, they'll offset your liability in the state, which typically, if you're going to a state you're not typically working in, would be 0. So you get that dollar for dollar return. Transferable means when you get that return, you can't use it to offset your, or you can't get a check from the state. And so you have to sell it to someone that does have that liability in the state. So think of like a Groupon, right? Remember those where it's like you're getting, and that's why people buy it, is like a Groupon. Is like somebody in Georgia, for example, if they're like Chick-fil-A or something, would say, hey, I'll buy your $1 million of tax credits for 900,000 or whatever it is, so that they get more on their tax return to offset their liability, and then you get the cash. So that's how transferable works. You have to sell it to somebody that can use it, because typically you won't be able to use it and you can't get that check back from the state. Those are the basic ones. There's some other ones that kind of fall in between, like partially refundable, which is kind of a mix of the two, and then non-transferable, non-refundable, which means it can only be used to offset your liability in the state, meaning like what you owe in taxes, your corporation owes in taxes to that state. So you can't get a check from the state from that. You can't sell it. It's just kind of stuck with you. So that's kind of the basics and very layman's terms and very quickly. I'll take a breath and see if Jeaneane has anything to add to that, but that's like the very, very basics of like incentives shelf definitions.
Yeah, no, I think that's great, Ryan. One thing I'll just put like a little finer point on is around this like partially refundable, or what I sometimes like to call like redeemable tax credits. So that's sort of like a hybrid between refundable and transferable, where instead of transferring to another third-party taxpayer, you're actually sort of redeeming that tax credit back to the state taxing authority itself, and usually at some sort of discount. So Louisiana is sort of the shining example of that at this point in time, because that's the only way you can actually like monetize that credit outside of actually offsetting one of your own liabilities. But Massachusetts also like has that as an option in addition to being able to sell it to third parties if you wish. And then in the international context, I thought I would spend like 15 seconds on this just to acknowledge that this is another form of tax incentive, which is the concept of a tax shelter. I know that term can be like very loaded in certain contexts, but it is just the term of art that has been chosen to describe a situation where it's not the actual producers or production company that benefits directly from the tax incentive, but rather investors who actually put their own funds into the production are able to access tax benefits that they otherwise wouldn't have. So the production's still benefiting from this tax shelter program being in place. It's just they're getting it indirectly through third-party investors who in turn are the ones, benefiting from the actual tax program.
Yeah, it's a great call out. And I think all these ones we've listed are important before we even kind of dive into the programs. Just because if you're budgeting, you need to be aware that if you're going for a transferable state in your, you're working with a financier or whatever you might be doing, you're not going to get that dollar for dollar return. Don't say you're going to Georgia and getting a true 30% back. You're not. You have to sell that. So there has to be a discount there. So you should put that in your budget. Whether it's partially refundable, like Jeaneane said, for Louisiana or Massachusetts, you have to put those numbers in there. So even before we like dive into programs, it's important to know for independent producers and everybody working on the budgets that you should plug that in there so that your numbers are accurate and you don't think that you're getting this giant cherry and you're not doing the real numbers and the real math with that. With that can also come along certain fees that go with these types of credits. So some states have transfer fees. New Jersey has like an issuance fee. A lot of states now are saying, hey, we want a certain fee off of the credit to go towards like a workforce development plan. California's doing that. Louisiana does that. There's quite a few of those there. So every state's very unique, which we'll talk about in a second, but I think it's important to know just budgeting, even on the most like top tier level, that you should be aware of these things, these little things that can kind of creep up and affect your budget. So now that we kind of have gotten those definitions out of the way, one of the questions that did come up quite a bit in the preliminary questionnaire was about the federal on the domestic level. So, there's a lot of talk about where it's at. what the process is. Do I qualify for it? Do I not? What is it? You know, a lot of people just think, oh, there's just certain states, but there is the federal program as well. So, Jeaneane, what can you tell us about the federal offering from the U.S. perspective, and what's it called, and kind of the ins and outs of what people should be aware of if they think they would go for it?
Sure. So first and foremost, all the things that we just described are not what Section 181, and I'll get into it in a second, Section 168K are. What these two code sections provide for in the US tax code is an accelerated deduction. And it's an acceleration of a deduction that would be available otherwise, just over a possibly longer period of time. So while all of these like other tax credit programs really do like impact your like bottom line, what Section 181 and 168K do is just help with time value of money when you are filing a US income tax return. And you also have to be the copyright holder. So these incentives really aren't available for every type of production. Section 181 was first enacted back in 2004, and this was Congress's sort of first attempt to help curb what they called, runaway production. Not only is Hollywood leaving Hollywood, Hollywood's leaving the confines of the US. So they said, look, okay, US studios, copyright holders, to the extent you're making a production, which is essentially 75% at least made in the US, they look at a compensation test. If you meet this, then you can get up to like $15 million of your program deducted like as you pay, which is great because otherwise, like films are considered long-lived assets. And so as you're building this asset and incurring all these costs, those actually get capitalized into an asset, which again, everything else being equal, usually has to be deducted over several years as opposed to like all at once as it's being incurred. So Section 181 can be a nice benefit to anyone who actually meets all those parameters. And it does provide sort of like a time value of money savings, but it's not what we would consider the types of incentives that, are the focus of almost everyone here. 168K came in 2017 as part of the Tax Cuts and Jobs Act. It mirrors Section 181 in a lot of important ways. The two big differences is that there's not a $15 million sort of limit, which is great. It technically scopes in all your production costs. But there is a placed in service requirement, meaning you can't start expensing things as it's being incurred. You have to wait until you've actually like completed your production and started distributing it in some form or fashion. So those are the kind of two key differences. 168K is in the process of being phased out. So for 2025, you're not getting 100% expensing, you're getting 40%. So, it's losing its value unless, of course, it gets sort of like reinstated. And I think that was a question as well, just, what are the chances of 181 and or 168K getting renewed? There are chances. 181 has enjoyed sort of like bipartisan support for a long period of time, and that's why it's been renewed so many times. So, we can't say with any certainty that it's definitely going to happen, but it is something that has been renewed historically.
Yeah, fingers crossed on that. I think it's a good call out in the sense of I talk to a lot of independent producers with my day to day, helping them with their budget, decide what state to go for and all that good stuff. And a lot of times I'll just kind of see buried in their budget that they just think they're going for the 181 and they just haven't done the homework. So like those perimeters you laid out, I think are important to know. It's an amazing program. It's terrific if you can get it, but just make sure you speak to somebody like myself, Jeaneane, or an expert in the area that has navigated that, even a tax lawyer or something, to where if you hit those perimeters, because it's not just this like, hey, we're going there and hitting this marker. There's certain things you have to do to ensure that you're doing it. And like Jeaneane said, it's kind of an outlier with regards to the standard incentives we've talked about and what we will talk about. It's this deduction kind of based incentive. So thank you for that. As we're jumping, so I guess with that, we'll jump into domestic. You know, one of the things that I do see the most, and people, you know, especially with independents, is they're creating when they start an independent, is they create that LLC for that independent, right? And there's a multitude of, or whatever it might be, an entity for that independent. There's a multitude of reasons that a independent would do that before they just film in general, whether they're going for incentives or not. However, some of these setups are required based off of the state you're going to. And you know, Jeaneane, I don't know if you want to talk about the choice of entity, why someone would do one or the other, based off of, you know, setting up, hey, we're about to start this project in Georgia or Massachusetts, whatever it might be. You know, what's the need? Like, some people didn't set up their LLC. I'm dealing with this right now, where the LLC was not set up on the front end, so there's a couple ramifications with that. So what are the advantages of setting that entity or corporation up specifically for a project before we go into one of these incentive states or jurisdictions?
Sure. Yeah. So I think really it boils down to like, how is the incentive ultimately going to be monetized? Because that will inform how you sort of set up your entity in the first instance. And I think the classic example to point to, not that there aren't others that like, you know, fall into the same category, but New York. New York is wonderful because they offer a refundable tax credit. So you know that like you're going to get dollar for dollar of that face value. Either you're going to be offsetting tax that like you already owed, so that's tax savings, but to the extent your credit exceeds any of your tax liability, you'll be getting that back in cash. So it provides a lot of certainty as to, you know, the ultimate value of the incentive. But it is a refundable tax credit, right? So what New York wants to see is that that credit is claimed on an actual income tax return. So for the unaware, maybe your production company is otherwise set up as a partnership. And maybe that partnership has like 20 different partners involved in some shape or form. If that partnership then drops an LLC, a single member LLC to run production through, the tax credit might be issued in the name of the LLC, but the LLC is not going to be filing an income tax return. The partnership is actually going to be filing an informational return, and it's the underlying partners who are filing the income tax return. So if that LLC had just been formed as a corp in the first instance, then it could, you know, claim the tax credit on its own return. Since it wasn't set up as a corp, that tax credit actually has to be distributed out to all those different partners, which just makes the monetization process that much more challenging to comply with. So it's, you really want to think ahead of like, hey, this incentive, once I get it in my, you know, hot little hands, how do I monetize it from there? Am I going to need to file it on an income tax return? Okay, well, then maybe I need to make sure that my entity is an income tax filer in its own right.
Yeah, I mean, it's a really good call out. It's just a protection basically for your company, your partners, and then for that, and then like Jeaneane said, kind of almost compartmentalizing that project for the sake of monetization, of transferring it for a variety of things. With that said, you know, we're talking about monetization. A couple questions did come up about financing against the tax incentive. I'm not going to go in great detail as I'm not a financier, but I do work with quite a few of them. So on a very, very basic level, here's what I would say for anyone that's like looking like, hey, I'm trying to build up money for my independent. Oh, I'll just finance against the tax incentive. And that just seems too good to be true, right? So this is what I would say. Keep in mind that when you're financing against a tax incentive, the majority of these tax incentives are based on the fact that you're going to complete this project and that project's going to happen. So what that means is no one, no lender, no bank, no person that specializes in financing or monetizing against tax and production tax incentives is going to lend that to you if you don't have the rest of your money in place. They're not going to do it because, once again, they're impeding on the fact that you will complete this show, you will film there, and obviously you can't do that if you don't have the rest of your funding in place. So just know that when you're financing against a tax incentive, that portion is typically the last piece in. So if you're financing against, I'm picking on Georgia, but Georgia or Louisiana or any of these ones, Massachusetts, whatever, New York, they're going to say, okay, where's the other 85% of your funding, and then I'll come in and finance the last piece based on the fact that you're going to go there, film there, and get a certain amount back, and then they'll finance that, and they'll include, there'll be interest gathered and all that fun stuff. But I just want this audience to be aware. You can't just say, well, I see that I can go for, the Missouri tax credit, so I'm going to plug that into my financing as, yes, I'm going to get that financing and that's already in the bank. It's not, because the financiers are going to want to say, do you have the rest of your funding there? So then they can come in and monetize that. So I'm not going to go down the rabbit hole of financing, but I just want that to be aware for this audience is it's the last piece of the pie. And it's also, I guess, another good point, it's still going to be the first one out too. Is as soon as you get that tax credit, those people that financed again it, they're going to want that money, the very first people right in line to get back your return, to get back your reward. So always remember that when financing gets tax credit, the last piece in, first one out. Okay. So Jeaneane had mentioned New York, and I think that's a good place for us to start talking about the domestic states and kind of what's going on across the map. I'll give everybody a guess of what the most popular question was with all the questions that came in. Okay, 1, 2, 3. All right. The most popular one, which is always funny, is where's the best tax incentive right now? Wherever, US, domestic, international. It's always my favorite question because there's no answer. Everybody just got a big frown on their face. You have to remember that each of these programs, whether when we're talking about domestic or when Jeaneane dives into international a little later, they're all extremely unique. None of them are built cookie cutter. None of them are built exactly the same. Not one of them has, the same minimum spend plus the same return plus the same way you get it back and yada, yada, yada. So what it all boils down to is what is the best tax incentive for you and your production, right? If you're doing a very heavy above the line shoot, you're an independent, you're 3.5 million and 2 whatever of it is going to your above the line, then we can't send you to a state that has a above the line cap, right? Or has a low above the line cap, which means they'll only give you a certain amount of that because you couldn't maximize your return. If you're doing, a dock where you're bringing your crew from, California to a state, and usually docks are bringing their source crew there, then it's going to be really hard to maximize that in a state that doesn't allow for non-residents to qualify. So it, once again, all kind of depends on your type of project. So is it a commercial? Is it an independent? Is it reality? Is it a doc? Is it a scripted episodic? All that kind of plays into where you go. And then, the way that you're paying people and kind of setting things up can all kind of depend on where you go. So with that said, let's talk about some of those minimum criterias and why they're kind of important, especially for independent filmmakers. Is because this came up a good bit too, was people saying, I'm an independent filmmaker and I don't think I'll qualify because I'm doing a $300,000 show, right? Or I'm an independent filmmaker and I don't think I'll qualify for this because I'm shooting internationally for half of it and the other half I'm doing in the US. I think it's important to know that there are a lot of people that are leaving money on the table just because they assume they don't qualify, right? I think it's important to know that, like New Mexico, for example, does not have a budget, a minimum criteria that you have to spend there. They review your script, but you don't have to, for their baseline incentive, you don't have to spend $1 million there or $500,000 there. You know, Massachusetts, extremely low threshold, right? And then same with Mississippi. Some of these states are, you know, you're talking about $50,000 to spend in the state in order to qualify. And so don't ever just assume that, oh, I'm doing a small thing, it's $150,000 passion project, but I've got the funding. Don't always assume that you wouldn't qualify for one of these programs. It's always worth it to kind of do your homework and see if you'd qualify. Gina, anything to add to that with like minimum criteria and spend?
Yeah, I totally agree with everything you just said. Sometimes the like minimum spend thresholds aren't even like at a jurisdictional basis. Sometimes like Canada, for example, references sort of like your global budget. So they're not necessarily asking you to spend a certain amount in Canada, but as long as the project as a whole is meeting sort of their minimum budget requirements, that does give you entry. The flip side of that, though, is that just because you may meet the minimums doesn't mean it's always going to be like an ROI positive endeavor. So it's very easy to like, if you had one VFX vendor in Canada doing like a tiny contract, you may be able to like qualify based on the rules of the program, but after you consider those other costs that are involved with the pursuit, you might end up sort of like, breaking even, in which case, why would you spend the time and the effort? So just again, further to Ryan's earlier point about costs associated with each pursuit, it's very important to think about that when you're evaluating your budget holistically.
It's an amazing point. I tell it to people all the time. I'm so glad you said it, is to do the math and figure out like, yes, I meet this minimum spend here and it's a great program. That doesn't necessarily automatically mean that's where you have to go, right? Is like if you're California based and you can film it in your backyard with your friends and you got to deal at a vendor up front, who cares if another state's giving you 30% back if you're able to do it at home, with certain resources. So I think it's a great call out to like not just chase the pursuit or not just chase what's like popular or I have to go there because everybody's saying it's such a great program. Do the math. It could be the best program ever for you, but maybe it's just a wash, or maybe it's like you have to fly your whole crew out. Did you budget for per diem and hotel? Did you do that? Do the math, do the homework. Great call out. So um, the questionnaire did have quite a few of the same states come up, and we can talk about a few of those. So we talked a little bit about New York. New York is a very popular program, and it always has been. It seems every year on paper it's getting better and better. Current state it can get upwards of 40% if you shoot upstate New York, 40% back in a refundable credit. They now allow for certain above the lines to qualify, which blew my mind when they did that because I never thought California or New York would ever entertain that. And the fact that New York did that, I was like, okay, wow, they're really being aggressive here. And maybe it's the competitiveness between states. New Jersey has a fantastic program right now, so they're competing against New Jersey. But the fact that they did that was really surprising, in a good way. And then if you shoot upstate, there's even some local incentives that you can capitalize on in New York, with Syracuse and that whole county that's in, has its own incentive as well that you can piggyback on top of the state. And they have some bills currently to make New York even better. I think that it's important when we talk about like, oh, the state's so fantastic that we also talk about the realities of a program. New York is a fantastic program, but in the past, people have stated that due to the way the legislation and the rules are drawn up, that the return to get back that money can take a while. New York was To be frank, in the past, one of the longest to get back. It might have been the longest of touching almost 5 years. But about 2 years ago, it might be a little under that. The state did, I personally think, an amazing effort to alleviate that and hopefully shrink that window down by doubling their staff in the office, almost doubling their funding overall, and removing a wait period that you have to do in order to file your tax return over there. So even just by those efforts alone, it should shrink that window, hopefully dramatically. I'm just not sure if we have, and Jeaneane, keep me honest, I don't know if you've heard, I'm not sure if we have real, since that's kind of a newer change, if we have real world data of like, has it shrunk the return? It should. Like, just getting rid of the 1 year
But
wait period in itself should bring it down, right?
yeah, that in and of itself, and also just increasing the funding, because one of the reasons it was taking so long in New York is that they were borrowing ahead of future years, like budgets and allocations. So you might submit your final paperwork in, 2022, but get an allocation year of like 2026, and so now you have to wait until 2026 to even start claiming, and you might be, if your production is sufficiently sized enough, you might have to claim over like a 3-year period. So that really was sort of like, drawing out the window with the budget having been increased. That in principle should reduce the amount of like borrowing ahead, and getting allocation years from like the far future. And then again, instead of doing allocation year plus one, now it's just the allocation year.
Yeah. Yeah, and New York, obviously I mentioned it as healthy competition with New Jersey. New Jersey is a very popular program right now. It's transferable. They have a partnership program, production partnership program similar to New Mexico, where you see companies like Netflix, NBC Universal, and a few others now kind of putting roots in states like New Mexico and New Jersey because they have these partnership programs which will entice studios to go there even further because like in New Jersey, they up the compensation caps and the overall funding that those people can get. In New Mexico, they're not withheld upon by their ATL restrictions that New Mexico has, as well as some of the funding restrictions, even though they still get like over 100 million a year. If you're a production partner, you're not handcuffed to that. So there's some interesting things that states are doing. A few other states before we kind of move on that people brought up. Obviously, California. A lot of people brought up they kind of want to know the future state of it and the current state based on everything that's going on, especially with the fires and everything. What I'll say is this: is while that was all happening, like literally while everything was happening in the state of California, they still had their application window open for films. So they were still, looking to accept those applications to entice people to come. They understand how important it is for the economy, and they want people working. So I certainly don't think it's going to go away. And the 4.0 right now they're in a 3.0 program. That's the name of their program. 4.0 will start is still set to start this year, which allows for some interesting choices you can do. You can typically the way California works very quickly is for like studios and whatnot. It's non-transferable, non-refundable, which we talked about. And then for independents, yes, they have a carve out for independents. We got a lot of questions about that. So independents can go after the California incentive, but there is a vetting process that can be cumbersome to say the least, but it is there for you. But um, the funding does look like it has been allocated for independents still. So like you are able to go after those and the windows seem to be open for 4.0. I think you can choose between transferable or fully refundable. Well, not well, it's actually partially refundable for independents. So there's some interesting things coming with 4.0, but I just want this audience to know I don't think California's incentive is going anywhere. And they plan so far ahead. I mean, 4.0 was released like almost a year ago that they said it would happen in 2025. So I don't know if Jeaneane has anything to add to California, but I mean it's still a great program. Independents can go after it. I don't want to dishearten independents from going after it because a lot of times they just don't think that they can. But there is a carve out for you. There's a pot of money just for independents.
Yeah, that's a great point. And there's always been sort of this carve out for independent films, which allows those taxpayers to get a transferable tax credit, but it was also capped. So it is possible you might be an actual independent TV producer, in which case you really didn't fit into that independent film bucket. And you might not have sufficient California tax liability to absorb whatever credit you might be generating. And that's where 4.0, addresses that sort of specific concern where the independent films still have their transferable tax credit. Every other type of content can sort of redeem those credits back to the state.
Yeah. Yeah, I thought it was an interesting choice. And then I think it's allocated over a certain amount of years. And there is like a little partial, like a carve out for it. But just the fact that they were kind of thinking outside the box, once again, I was surprised and also delighted to hear it. I'm trying to move fast for being conscious of time. So, those are some popular ones, of course, with California and New York. We did get a question quite a bit about some lesser known incentives, like, hey, are there any ones that I'm overlooking in the states? I personally will say that I talk to a lot of independent productions, and a lot of them are horror based. And I send a lot of horror movies actually to Mississippi. I think it's a great little gem of a program. It is a rebate state, so no need to do any of the tax filings or tax ramifications that come along with a tax credit. They are pretty well funded. They have a terrific film office. Their minimum spend is extremely low. And I always tell people they incentivize residents, so there is a crew base there, and they incentivize non-residents as well, so you can grab people from New Orleans and Louisiana to work in to work in Mississippi. And if you're just, a lot of these horror shows, there are one location in a house. And I'm like, you could go to Mississippi and like totally, garnish quite a bit of return there. So I love to send the people there. I really like North Carolina too. They're a grant. The reason I like North Carolina for independence is because their application process is extremely streamlined. It's very straightforward. It is a grant and a rebate program as well. They give you 25% for your residents and your non-residents. I would say the one caveat with independence there is your minimum spend, I believe, has to be, I think it's $1.5 million still. It's definitely over $1 million in order to spend in that state. So if you're like a 750, then maybe you go back to Mississippi, like I was saying. So just throwing some out there. Jeaneane, I don't know if you have like a gem or a state that you don't hear everybody talks about. California, New York, Louisiana, Georgia, New Mexico. You hear those so much. Are there any ones that you've had experience with that you just don't hear a lot of?
I suspect there's probably lots of folks in the audience who are familiar with this program, but just to give it a little extra airtime, Manitoba in Canada provides really, really great returns on local labor. So as long as you don't really require like a household name to be your like lead talent and you would be open to sort of hiring locally, it can be a very, very lucrative incentive, especially for some of those smaller budget projects.
Yeah. And I think once again, to my point earlier, it's important to note that it also depends on the type of content that you're creating too. I do work at Wrapbook, we work with a lot of unscripted content as well. So whether it's reality, docs, game shows, those types of things. And once again, there's this built-in mindset of I'm reality, so I don't qualify for these incentives. And it's simply not true. You can qualify for some of these incentives in the states that allow for it. There are certain states that allow for reality and docs and unscripted, and there's some states that don't. And there's like Rhode Island will qualify your docs and other unscripted, but it won't qualify reality. So it gets very granular of the way you kind of describe your project. Connecticut, I see, do a ton of unscripted stuff just simply for the fact that they allow for post only. So we're actually seeing some unscripted companies set up base in Connecticut because they can film elsewhere And then since unscripted is so heavy in post, they will go and do their post in Connecticut and get that terrific return with their transferable credit, which can get upwards of 30%. So it's very interesting to find ways to make the credits work for you, right? So it just don't assume. Once again, don't leave the money on the table by just assuming we don't qualify because we're this, that, and the other. I think that's a good segue into the biggest mistakes that people see, that we see. Me and Jeaneane have seen through our career when people are utilizing incentives. Jeaneane, is there one that stands out to you where you're just like, oh, I wish they had known about that? Or has that come up in your career where you were just like, oh, this was not this I wish this was handled better because there was just one simple thing we could have done in the beginning to alleviate this.
Well, not to beat a dead horse here, but definitely the entity set up in New York. Just finding out, after it's way too late in the game that like, oh, this is a single member LLC rolling into a partnership. Partners are scattered all over God's green earth. This is just going to be so much more cumbersome to monetize than if a simple election had been made with that LLC and have it be taxed as a corporation.
Yeah. I think, yeah, I mean, setting stuff up, anything you can do to avoid more work retroactively, doing anything retroactively, especially for any of these tax incentives, is, to be frank, a nightmare. I don't know how else to describe it. With that said, I would say the biggest mistake I see is just not tracking and flagging things correctly throughout the course of your show. And what I mean by that, so if you're working with a production payroll company like Wrapbook or any of the others, you should be given tools to track and flag those costs to make sure that what did you spend in New York, what did you spend in Georgia, and make sure that you're flagging them correctly and that your accountant is working with people that have the knowledge of what qualifies and what doesn't, so that at the end of the day you can run reports and kind of see, are you on track to meet a certain incentive? Are you on track to get what your estimated return will be? So, I mean, I would say that, having that proper software like a Wrapbook, plug, to make sure that, you're flagging correctly, you're ingesting that information, and that it's all organized and easy to calibrate to reporting, and also to the auditors, is a big deal. I'll use that as a segue to the auditors. These states, and I'm sure Jeaneane will talk about with international, typically require an audit of some kind. What I mean by that is either the state will audit it, but a lot of times they'll say, hey, a third-party auditor, someone that's been approved by the state, licensed by the state, whatever it might be. Once again, every state's a little different on what they require, but an audit is typically involved, or at least highly recommended. Like Hawaii, I think, changed theirs to where it's not required, but they say it's very highly recommended. In order to make sure that your money, your flagging, your cost is all correct. So they're kind of the gatekeepers of the credit to make sure you do everything correctly. And to be engaged with those auditors, to know exactly what they're looking for, to know the way that they like to see clean books, that just can't be overstated enough. Like it's so important to have those discussions with your auditor, and just kind of know what they're looking for so that you can prepare it from the very beginning of the show all the way to the end. Jeaneane, I mean, I'm sure you work with a lot of the same auditors I have, so.
Yeah, no, yeah, I'll just put like a little asterisk on that, or just call out something particularly nuanced with like the UK. So when we use the word audit, we're being pretty loosey-goosey with it, from like a
I'm
strict.
loosey-goosey. That's just
No, I mean the industry as a whole, We call a lot of things audits, which are really more like agreed upon procedures, or like, attest engagements, where the CPA or chartered accountant is sort of signing off on like a process, but it's not a full audit from the sense of like, a complete review of the entities, like books and records and accounting policies, et cetera, et cetera. So most of the like state level audits are sort of these like attest engagements. In the UK, however, like it is an actual like statutory audit performed under UK GAAP. So when it comes to like budgeting sort of your net incentive in that jurisdiction, just be aware that sometimes those like full UK GAAP audits are a little bit pricier than what you might see in the US for like your average sort of or incentive at test engagement. And that's because the UK is looking at all of it, not just the actual tax credit.
Yeah, I mean, I just, one of the questions that did come through specifically, we had a few about audits, but was like how granular does the tracking have to be for the audits, and for the tax incentives? And it all goes down to those audits. And it does have to be pretty granular. I mean, those are the things that they're doing. Some of these states will do like a sample report, so they'll pull certain like items out and they'll see if anything's a red flag, based off the agreed upon procedures in certain states. Other states like Connecticut will do like a full audit. So that goes once again to my point at the beginning of the call of like budgeting appropriately. If you're going to a state that requires a bigger audit than others, you better put that audit cost in your budget, because otherwise that's going to sneak up on you at the end. And you're going to be like, wait a second, I didn't know I had to pay, whatever it is, 20 grand, whatever it might be for an audit. And so it's just important, once again, when you're going for these incentives, and I'm going to say it a few times and a few more times, to just be in the know, do your homework. Actually, Wrapbook.com. I'm going to do the shameless plugs throughout. I don't care. It's fine. Wrapbook.com, we have the incentive center, and we kind of break down, even we're starting to add all the government forms that you'll need when you're going for incentives in certain jurisdictions. So, do your research, do your homework on these things before you kind of just jump in and say, oh, it's a great program, I'm getting 35% back. So let's see, what else, what other questions? I'm reading through the questions. You guys can see me reading them. That's okay. One person asked, can you go for multiple programs at the same time? That's an interesting question. I've certainly been asked it quite a few times. It depends on the two jurisdictions. So we talked about minimum criteria. Some states will say, for example, Pennsylvania will say, 60% of your filming has to be done in Pennsylvania. And Texas has the same criteria. A certain percentage, a high percentage of your budget has to be filmed in Texas. That makes it hard to divide up those two states, right? Because a certain percentage has to be there versus there. But when you're dealing with, I mentioned Mississippi, I'll say again, it's on the, it's on the line of Louisiana. I've certainly had states have had projects go for both of those. They've done a few days in Mississippi. They did a good chunk in Louisiana. They hit the 300K requirement in Louisiana. They hit the minimum criteria, the 50K in Mississippi, and they have a few other criterias you have to hit as well, but they're not super complicated. But they were able to maximize both those programs. It's not always super easy because, I mean, if you're going across the map, that's going to be hard. I think to Jeaneane's point earlier about doing the pursuit, like I wouldn't certainly say, oh, well, I have to do, Georgia and Manitoba because those are the two best things, and I want to go to the two best places. But I think be smart about it and just know if it's like a neighboring state for the sake of travel, hotel, per diem, and whatnot, that's usually easy to do. I think it's also worth noting that if a state like Connecticut or a New York has a post-only incentive, that you can go for both of those at the same time. So New York has a very well-used post-only incentive, meaning it's just post. You didn't have to shoot there. Let's say you shot in Georgia or Kentucky or wherever, and then you did your post in New York. You could technically do both those programs, right? For once again, the boots on the ground you did on each of those, right? So none of your Kentucky spend can be utilized for the New York Post, and none of that New York Post that was done in New York can be utilized for your Kentucky spend. So you just have to remember to do that. Jeaneane, with international, I mean, I would assume that happens a good chunk, especially with post, right? There's a lot of post that goes to Canada.
A lot of post that goes to Canada, a lot of VFX that goes to Canada. Similar sort of programs exist also in like Australia and New Zealand that are catering specifically to like post digital animation visual effects. And then it is possible to do post only pursuits even in jurisdictions that don't necessarily like advertise that they have a post only program. It's just that if you are able to meet, all the different requirements based on your post production activities alone, there's nothing precluding you from doing that. And it can be a little challenging, but I've seen it a lot in the UK. A project might be entirely filmed in the US, but if you're working with a UK director and producer, they're probably going to want to, go cut everything back home. So it does take some, upfront planning and diligence, just making sure all the pieces are going to marry together well, but it's fully possible to do that.
Yeah. I think this is a good segue to kind of a more international, discussion. And I am not self-proclaimed an expert in international as Jeaneane is, but when I do talk to my clients and they say we're going to Canada, we're going to UK, whatever it is, the thing that I tell them a good chunk is my understanding is it's great to work with, a local fixer, a co-pro, a company there that at least knows it, especially if they're flying in blind and they've never, filmed in a certain jurisdictions before that's foreign. But I'm mentioning co-pro a lot. I hear co-pro a lot. Can you expand on, I know it's hard because once again, every jurisdiction is different, but maybe in generic terms of like, what a co-pro is, when are they used, when are they not used, do you have to use them, the advantages of it, because it seems to come up so much with, especially producers that are from the US going to shoot internationally.
Yeah, and I'm just conscious of time because I did prepare a small dissertation on the concept of co-productions, but I'll try to keep it brief. So first and foremost, there is often like confusion around what like a co-production even means. And the like most basic definition is anytime two producers are partnering together on a production and sharing resources in some shape or form. So a co-production can look like all kinds of things. A lot of times what people are truly asking about or intending to ask about is what's called an official co-production or a treaty-based co-production. And those happen when producers from one or two or more countries who have some sort of co-production treaty in place between them sort of partner together, and after meeting all the requirements laid out in the treaty itself, it allows each of those producers to claim that project as a national title. So if we're talking about, Canada and France, maybe there's a French producer's Canadian producer, French producers contributing 25%, Canadian producers contributing 75%. If they tick all the boxes of the treaty, that project is going to now have French nationality as well as Canadian nationality.
Oh,
Now,
interesting.
why does that matter? Like, especially for anyone based in the US, we don't spend a lot of time thinking about like nationality or country of origin for most of the stuff that we produce, because honestly, it's not been a super big priority. That's one reason like we don't have any co-productions in the US because it's never been that big of a concern that like US content wouldn't be made. So these co-production treaties exist in countries that have historically placed greater importance and emphasis on national productions for a variety of reasons. The three biggest ones are incentives. Oftentimes, there are completely separate pools of money that are set aside for promoting the generation of national content. It can be important for award show consideration. There's a lot of award shows outside of the US which are only for, projects of that particular nationality. And it's also important sometimes when there's content quotas in play. So Canada very famously has had sort of like requirements on broadcasters with respect to Canadian content. Well, now I've like gotten my project stamped and certified as a Canadian French co-production. It has Canadian nationality. now a broadcaster who's subject to these like quotas is going to be willing to pay a higher price to distribute my project relative to something that doesn't have that Canadian nationality. So anything can be a co-production. An official treaty-based co-production requires that there's actually a treaty in place between the like relative countries in play.
Gotcha. Yeah, so it's that is a bit of an open-ended question for me to say. Can you tell me co-productions? Because sorry to put you on the spot with that. But yeah, I mean, it's interesting you talk about the award shows, and I've sat on many panels with me and you have sat on panels before, and we talk about international stuff, and certain things of content seem to come up. I think it's called like I hear about like culture test, and you mentioned award shows, and I've also seen that a lot of the international stuff, it doesn't seem, or at least from my viewpoint, maybe I'm mistaken, that they incentivize as much of like unscripted stuff outside of docs. I do see a lot of docs, and I do work with, once again, a lot of documentary filmmakers that will film abroad. But is there any, we talked about some of the states that allow for reality and unscripted in the US. Is it harder for unscripted and whatnot to go for international as a whole, or is it just not as like showcased as much?
Look, I can't profess to be like a super deep expert on this. I do know there are definitely some international incentives that will specifically, support unscripted projects. Ireland recently just sort of expanded their notion of what qualifying production would be, which is, welcome news in that community. Um, I believe Malta also allows for unscripted, so it's not impossible. It may just not be entirely pervasive.
Got you. And I mentioned the culture test, and I've heard that a few times too. I think that's kind of interesting, and I'd love to hear like exactly what is the culture test, because I mentioned like North Carolina, and I mentioned Texas, and these are grant programs, and a lot of times in the states with grant programs and rebate programs, they kind of come with this caveat of, hey, we've got this pot of cash, like I talked about, but we want to approve that we're in a good light, that the state's portrayed in a good light, or that you're not doing anything that we disapprove of. Is that basically the US version of the culture test for whoever offers that?
Yeah, I would say it's a little different just because in those like state examples, it's a lot more discretionary in nature versus the culture tests that we see most of the time are, European cultural tests, not exclusively, but that's sort of set out by EU state aid rules where they want ultimately supported projects to be European in some shape or form. So that can look like a lot of different things. And these culture tests are, pass fail, they're binary. And there's a lot of different ways to collect the sort of minimum points necessary to pass, right? And that doesn't involve like, hey, is this portraying this country in the light that I expect it to? It's really more like, what language is this production in? Who are the key personnel who are engaged on the project? What are we seeing on the screen? Is this a European story? Does it have like roots in, European literary history, etc.? So at the end of the day, those programs are still considered automatic because as long as you tick the boxes, then you're eligible without someone really like formally reviewing.
Gotcha. Yeah, and with you mentioned Europe, but and you talked about runaway production earlier. And one of the things I do for prospects and clients is I do weigh budgets, and I'm usually comparing states. So I'm comparing, Kentucky to Missouri, or whatever it might be. I'm comparing two states. But lately, the budget seems to be a state and the UK. Why? From a tax incentive perspective, let me rephrase that. From a tax incentive perspective, why do you, what is it that the UK is really the big flag that they're waving that's attracting independent producers and projects?
I mean, there's no other way to say it other than the UK has always had like a very lucrative incentive that they keep improving upon, you know, basically year after year. Ever since I started working with the UK incentive, I've just seen it go from like really solid to you know, exceptional. And there's a couple of key reasons why. You know, the notion of what's eligible spend is very broad. The UK turns on this concept of like used and consumed. So
Hmm.
essentially, as long as it's taking place in the UK, the underlying like nationality or origin of that person or object is, you know, not important. So you can get your costumes shipped in from Italy, and as long as they're used, you know, for filming only in the UK, then those are going to qualify. Um, I won't get too much in the weeds with like this concept of neutral spend, but just know that there are categories of like mostly above the line individuals and sort of the underlying rights that can be attributed to the UK in ways that you wouldn't like normally expect in any of the US domestic programs. And there's always been sort of an openness to allow for deferred payments to also attract the incentive. And there's, you know, there's special rules involved with that, but it doesn't just stop at your production costs necessarily. If you're paying participations and residuals, there are ways to qualify those as well.
Wow, that's really interesting about the used and consumed. There, you're right. That's a big change from most of the U.S. territories. I think the only two states that even have something remotely similar to that language is Massachusetts and New York, right? Is they kind of have that, you know, used and consumed there. So that is certainly a good incentive for people to shoot there. With regards to, you know, you talked about Manitoba. With Canada, you know, Canadian productions. I just did a conference, a film conference last month, and there is a lot going on in Canada also. We didn't really talk about, and I'm putting you on the spot a little bit, but with the Canada, there's the jurisdictions, but they have the federal as well, correct? They
That's
have
right.
right, and is that it's a totally separate application and it offsets, right? Doesn't it? It offsets the local ones, or they don't do they you can't stack them or something, right?
You can stack them, but it's not like 1 + 1 = 2.
Right.
Because the way that the federal program works is that it's based exclusively on Canadian labor. And it says, we'll give you 16% of all your Canadian labor, but that quantity of Canadian labor has to be reduced by any provincial incentives that you're getting on that same bucket of labor. So very, very simply, if you have a project in British Columbia, I'm just gonna like make up a rate, so please don't get upset.
We're
It's just
gonna hold you to it. We're recording. Everybody's taking notes.
yeah, just
Jeaneane
pretend that
said. Jeaneane said, guys, yeah, here's a disclaimer for like me and Jeaneane. Like we do these things. We have you know, an expertise and an experience with it, but these things are always changing.
Yep.
So like, you know, we're doing a lot from memory here. So don't yeah.
So yeah, if you have $100 of BC labor, which is also $100 of Canadian labor, and you, based on the like rates that are in play right now, you're getting both the basic and the VFX uplift in BC. So you have 44% on that $100. The way the federal calc is going to work out is they're going to say, okay, you have the $100, you already incentivized it at 44%. So $56 is what's left to be incentivized at 16%. So, you know, you'll hear it commonly referred to as sort of the grind. It's still extra, but you have to consider first like what's already been incentivized at the provincial level.
Right. So it's not, you're really not double dipping, like, so to speak. It's
Right.
or as much. It's not a full double dip.
Yeah.
Yeah. Okay. So moving on, and I want to be conscious of time because I do want to leave this open for some live Q&A. So the last question that did come up quite a bit, and I think it's overall, and it's a good stopping point for the loaded questions that came in, was kind of where we see things going and what's kind of happening with the landscape. What I'll say, at least from a domestic standpoint, is that last year we didn't see a lot of changes with states. There was some changes to Illinois in the last year and a half, which was great. Kind of like New York, they added some above the line. You can do 9 positions now with above the line. You can do some SAG actors that are non-residents. Before, they didn't incentivize any non-residents. So that was a big deal with Illinois to do that for their above the line. They had a few changes. Missouri kind of outlined more of their rules on their newer program because Missouri and West Virginia are the newer programs. But it wasn't a lot that happened, to be frank, last year. This year, there are a slew of bills that are out there that can make some tremendous impact. I'm not sure why there's so many, but there is a lot. These things just kind of come in cycles. So I think it's just best to kind of keep your eye on the pulse. You can follow me on LinkedIn. I usually post when the governor signs the bills in real time and kind of describe what they are. But we're just seeing a lot of energy around. There's a lot of new stuff talking about with New York, which we feel pretty confident about. It just hasn't been signed yet, but it's in the budget bill to kind of give more funding to independents. So listen, audience, New York is really trying to get you to go over there. New York, Nevada has 2 really great bills kind of floating out there. Illinois is looking to change even more. So there's a lot of interesting stuff happening this year. And then we even saw some states like, which I love to see, like Kansas put some bills in where it's like states that don't even have programs start to say, hey, we kind of want to dip our toe in this because they realize that when you have an incentive, there's an economic impact that happens. I always say it's kind of like dropping this economic bomb into an area because you have crews come in and they have to spend their per diem, they're staying at your hotels, they're eating at the restaurants, and it's a tremendous economic impact. And that's why I just think, and Robin mentioned at the beginning, I talked to a lot of the state film offices. It's such a positive and integral part of their economic impact. And the trickle down effect is real. That goes from the hotels, the restaurants, and all that good stuff. So I would just say keep an eye out for those bills and just know that there's a lot of energy happening. I haven't been monitoring as much with international, but Jeaneane, have you heard anything that just kind of piques your eye of like to watch or anything kind of? You mentioned
Um,
Ireland was fairly new, and I remember them talking about that last year. That seemed like a one that people were talking about a lot.
there's a lot of stuff that just like recently happened, and some, more immediately recently than others. I think it should still be like acknowledged and celebrated that Australia upped their location offset rate from 16.5% to 30%, which puts it on much more
That's
equal
big.
footing with its other federal programs, which are, mutually exclusive. So before the PDV, post digital visual effects incentive was 30%. The producer offset for sort of like Australian flavored productions was either 30% or 40%, depending on certain circumstances. But then the location offset was stuck at the 16.5, and bringing it up to 30% definitely makes it a lot more competitive.
Yeah, that's almost double. That's fantastic.
Yeah.
Well, I'm this is kind of what we had with loaded questions. Jennifer, I'm seeing a lot of questions come in almost faster than I can look. You can help out and kind of pull out some ones that maybe we haven't addressed and maybe
Yeah,
do our best and
absolutely.
not be held accountable.
Yeah, there are quite a number of questions that came in about Illinois, so I'm glad that you just touched upon that a few minutes ago. I'm not sure if there's anything more you want to say about it, but I mean, 5 or 6 people are definitely looking to shoot in Illinois. One is a TV show. They're asking if they can submit their production as a movie to simplify the process. Do you know anything about that, Ryan?
No, they on most of these applications, they're pretty strict about the way you when you apply that you're picking the right category of qualifying production. In fact, this can even be not so much in Illinois, but in general, it can be an issue for some of the states that don't have a lot of the new media stuff written into their legislation, because it's like, where do you put them and how do you apply? And trying to figure out how to navigate that. A lot of states are usually open to helping you figure that out. But typically, if it's defined of like this is an episodic television show versus feature, it's not going to really affect you that much in Illinois. There's a ton of television shows that film there. I mean, all you have to do is turn on the TV and see like Chicago PD and Chicago this, Chicago that. And there's so much there. They have a terrific crew base because before they only incentivized the resident below the line. They still only do resident below the line, but now they opened it up to non-resident above the line, which is really great for only certain key positions. I believe there's 9 of them. And then they let you do SAG for a certain amount of your talent, depending on the size of your budget. So they seem to continuously be upping their program. And there's some really interesting stuff coming out from at least the bill they have pinned right now. One of the trends I'm kind of seeing, and I was talking to Jeaneane yesterday about this when we were talking about this exact panel, was that we're starting to see this trend of like facility requirements. New York does have this qualified facility requirement, and a lot of states have these bonuses. So New Mexico, New Jersey would be like, if you film in this facility, Missouri has film in this type of soundstage or facility, you get these bonuses. And it looks like the pinned bill for Chicago has some of that language as well. This stuff always changes. I don't like to talk about bills in great detail because they could die tomorrow or get passed tomorrow. We just don't know. But Illinois, great place to film. It is transferable. So like we talked about at the beginning, be aware that you are going to have to sell that. There will be a discount on it. So it won't be the true percentage return.
Okay. Sticking with transferable credits, there I think is still a little bit of confusion about these. People are really wondering, how do you find people to sell or transfer your credits to? Is there any insight you guys can give to that?
I mean, what I would say is there are some usual suspects, and what I do, at least with my clients, is I just kind of introduce them. I don't charge or anything with that, and I'm just like, I just want that client to find success. So there's usual suspects of those brokers that will, do that, whether they're based in the state or they're nationwide or whatever. There's also sometimes like the brokers are just like, oh, I'm working with a wealthy individual. You know what I mean? Like it doesn't always have to be, like I mentioned, a corporation or Coca-Cola in Georgia or something. It doesn't always have to be that. Like, oh, I don't have a landline to talk to Chick-fil-A. It doesn't always have to be that. That's why the brokers are around. Jeaneane, I don't know if you have anything to add to that, but the brokers are really going to be your roadmap for that.
Yeah, I mean, I would say 99% of anyone sort of in the independent space would be best served by, partnering with a broker. There's a handful of them. They all have their own sort of like client network, and are very effective at placing the credits. Because yeah, it would be very difficult to just like go door to door to see if you could find a buyer all by yourself. If you happen to be, a massive studio that's just cranking out an extreme high volume of credits, it is possible to sometimes set up like a direct buyer relationship that, sort of circumvents the broker, but most of the time that's not going to be practical.
Yeah.
Okay.
And the broker, I think the key there is when you talk to the broker, you just want to find out what your net return will be, because they'll have like some built-in whatever it might be. So you just say, well, what's my net return on this? If you have, and they'll say something like, oh, it's 80 cents on the dollar, or 82 cents on the dollar, and then you'll kind of know. It's also good to talk to those brokers even before you start, so you can kind of put that in your budget. I always try to tell people to put a buffer in that budget too. If the broker's saying, oh, the going rate right now is 85 cents on the dollar, I'll tell people to budget for 81. And then if we hit 85, great. Like cherry on top, we made that extra money. But yeah.
Yeah, that's a good point. That often by the time you're budgeting a project, it's well in advance of when you'll actually be able to sell the resulting tax credit. So it, it pays to be a little bit conservative on that front, especially if you're in one of the markets that's known for being a little bit more volatile.
Yeah, and that's something we didn't really talk about is that the transferability of these credits, it's supply and demand. So I'll use Georgia as an example. I've seen Georgia sell as high as the 90s, you know, the low to mid 90s and go all the way to the high 70s. So I have seen it move based off of like how much credits are flowing out there, how much need there is. It's going to move. It's going to change when you transfer the credit. So something to keep in mind.
That's really, really good advice. So no cold calling. You're not going to get on the phone and start seeking your own buyers.
No.
Um, Constantine has been patiently waiting since the very beginning. He has been asking about opinion letters from accountants. Is this something that you can shed some light on? Is it the norm? Is it just a US thing? Does he need one? What can you tell us about opinion letters?
My experience with opinion letters, I've actually written quite a few in my career. Typically, it's needed with the financier, where the financier wants some sort of independent third party to say, have you looked at this budget? Have you talked to this accountant? Do you know this program? Does it really look like they're going to get back $5 million? Does it really look like they're going to get back $1 million? And you kind of come there as a third party person and say, well, they said this and they said that would qualify. I'm not sure about that. They said they were going to this state and they said they were going to get everybody a resident. They said they would get every single person as a resident. And I'm there to say, there's no way. There's no way you're going to get that whole crew to be a resident. Their crew base isn't that deep. So then I go in there and I kind of cut that and do the opinion letter and say, I think they would get X amount back. They're not always needed. It just kind of depends on the financier. And there's quite a few people that still do it out there. I'm sure Jeaneane's seen her few as well. But yeah, that's the opinion letter.
Yeah, agree that it's like 99.9% needed just in the financing context.
Troy is asking if either of you are noticing now that multiple made-for-TV movies are being produced together, and is there any incentive limiting that type of grouped production?
So some states do allow for bundling. So like Georgia does, to where it's like if you didn't hit the 500,000, you could bundle your really small independents together to do that. The crux with that is you kind of have to be aware of it when you do the application. And applications in Georgia are due before principal photography ends. So you just need to be aware of that on the application. So some states do allow for the bundling. What I'm kind of seeing, which is kind of piggybacking on that question, in fact, that bill I talked about with New York has some of this language in it, is I'm starting to see more and more of an incentive and a bonus with some of these states that say if you film more shows back to back, if you do more of a coupling, not so much on an application, but just back to back shows, we'll give you a bonus. So I think Oklahoma has that off the top of my head. New York's pinning that. I think Missouri has that. There's a few states that have that where they're like kind of enticing you to just kind of stay here and keep filming back to back and keep the crews working.
We'll do two other quick ones and then we will wrap it up. John is asking, can a single owner LLC easily move to a corporation for a production in New York State? And is the best way to do it for a tax credit and audit?
So yes, you can change the like tax status of your LLC if it's really important for whatever reason to like keep that LLC. Alternatively, you could always just open a new company and do the election for that company. But there is a federal tax form that you file that either says this LLC wants to be elected as a C Corp for tax purposes or an S Corp for tax purposes. And Yeah, just be aware of the timelines on that though, because it doesn't really go retroactively. So that's why by the time you get to like audit, et cetera, if you don't have the right tax set up at that point in time, you're already a little bit too late.
Okay, and we'll end with this if either of you have anything to say about any film incentives in the US that have DEI requirements in them. And can you speak about those a little bit? And do we know if they're going to be impacted with the current administration, if you have any idea?
Go ahead.
Um, so kind of starting to see, I saw this trend, I guess about 2 years ago with some requirements for diversity, or at least what they call like your diversity best case efforts is what how the states usually word them. The first one to ever do it was at least domestically was Illinois. It's still in their legislation that you do have to just gather, and you can't force anybody to disclose any of that type of information, but you can add this form to their start work. We can add it to your start work at Wrapbook to where it's easy to fill out of like your ethnicity, gender, whatnot for collection and data purposes. So that is a requirement in Illinois. It has now become a requirement for that best case effort in Oregon, and now California has it built in as well. New York now has a form that mentions it. It's not so much, I don't know if it's required, but it's listed on their application packet. So starting to see it a little more and more peppered in. I think what New Jersey did is extremely interesting, is not so much make it a requirement, but they made it a bonus to where it was like if you hit, and they actually restructured the bonus last year. So if you hit certain perimeters with your diversity, you could get now upwards of 4%. So it goes 2 and then it goes to 4, based off of the parameters that you meet. So I thought that was really interesting to do it not so much as like a requirement, but as a bonus. So I do think maybe we'll start seeing some more of that. And yeah, I don't think that would change. The New Jersey one even includes women as well. So it's not it's not super stringent or focused on, you know, a certain group or whatnot. It's just kind of overall like, hey, did you try to hit these marks? If not, you kind of get rewarded, and if not, you're still going to get that 35% base in New Jersey, which is fantastic. And Jeaneane, I don't know if you have anything to add.
That's great.
Thank you guys. I think that concludes our session for today. I think Robin's going to come back on and do a little bit of an outro. Such fantastic information that you guys shared with us. It was very, very informative, and we appreciate it. And everyone should go to Wrapbook to get more information on tax incentives and connect with Ryan for more information.
Yes, thank you to Jeaneane and Ryan for your insights into, you know, what Jennifer was saying, this ever-evolving complex world of tax incentives. The recording of the webinar will be posted in the coming week. We will let you know when it is available to watch. If you're interested in these types of industry discussions, you can also watch all the recorded sessions from the 2024 American Film Market. Click on the program tab at the AFM website for more information. As for this year's AFM, it will be held at the Fairmont Century City Plaza in Los Angeles, November 11 through 16. We hope you will join us then, and thank you all.